Supermicro, headquartered in San Jose, California, is a U.S.-based technology company specializing in high-performance and energy-efficient server and storage solutions. The company's product portfolio spans AI servers, enterprise storage systems, blade servers, workstations, and networking products. A distinctive feature of Supermicro's offerings is its building block architecture, which enables rapid system customization and deployment. This flexibility makes the company particularly attractive to customers operating in AI, cloud, hyperscale, and enterprise environments where performance, efficiency, and time to market are critical. By providing modular solutions that can be tailored to specific workloads, Supermicro allows organizations to optimize both computational power and operational efficiency, creating a compelling value proposition in the increasingly complex landscape of data center infrastructure. This analysis is provided for informational purposes only and does not constitute financial advice. Supermicro delivered a robust Q2 fiscal 2026 financial performance, reflecting both rapid top-line expansion and improving operational cash generation. Revenue for the quarter ending December 2025 reached $12.68 billion, more than double the $5.68 billion reported in Q2 2025, marking a 123.36% year-over-year increase. Earnings per share rose to 0.60 from 0.51, an 18.23% increase, demonstrating the company's ability to translate strong revenue growth into incremental profitability despite margin pressures. On a trailing 12-month basis, revenue grew to $28.06 billion from $20.82 billion, representing a 34.76% increase, though EPS on the same basis declined to 1.37 from 2.28. Reflecting higher costs and investments in scaling operations. Free cash flow per share, TTM, improved markedly to 0.68 from negative $3.43, a 119.83% increase, highlighting the company's enhanced operational efficiency and ability to convert revenue into cash despite capital-intensive infrastructure investments. Profitability metrics further illustrate the company's performance. A gross profit margin of 8.02%, net profit margin of 3.11%, and free cash flow margin of 1.57%. Return on assets stood at 3.42% and return on equity at 13.19%, underpinned by a manageable debt-to-equity ratio of 0.76. Over the past 5 years, Supermicro has achieved a compound annual growth rate, CAGR, of 57.6% in revenue and 74.9% in net income. Though free cash flow has remained volatile due to ongoing infrastructure investment cycles. This track record establishes Supermicro as a high-growth technology company with demonstrated execution capabilities and continued expansion potential. Looking ahead, analysts project fiscal 2026 revenue of $41.44 billion, reflecting an 88.62% increase from $21.97 billion in 2025. Non-GAAP EPS is expected to reach $2.24, up 8.68% from $2.06 in the previous year. Despite strong growth projections, Wall Street maintains a cautious stance, assigning a hold rating with an average price target of 43-19, implying a potential upside of 40%. Notably, the highest analyst target of $93 suggests a potential 201.46% gain from current trading levels, indicating significant room for appreciation should the company continue executing effectively on its growth strategy. At the time of this analysis, SMCI shares were trading at $30.85 per share. Over the past year, the stock has declined by 2.03%, underperforming the S&P 500's 12.1% gain over the same period. However, the long-term performance tells a different story. Over the past 5 years, SMCI has risen 865.5%, substantially outperforming the S&P 500's 574.9% gain. From a valuation perspective, SMCI appears attractively priced. The price-to-sales ratio, PS, stands at 0.66, with a forward PS of 0.45, considered very low for a company participating in the rapidly expanding AI infrastructure market. Non-GAAP price-to-earnings ratios are similarly modest, with a TTM PE of 17.5 and a forward PE of 13.77. The free cash flow multiple, PFCTM, of 41.85 reflects variability due to infrastructure investment, but is consistent with historical norms. When compared to historical 5-year averages, both forward PS and forward PE are below typical levels, suggesting that the company may be undervalued relative to its projected growth trajectory. Guys, 89% of people watching don't like or subscribe to the videos. So please take a second to hit that like button and subscribe. It really helps the channel grow. Supermicro's growth potential is anchored by several strategic factors. First, demand for AI servers remains exceptionally strong, driving hypergrowth in revenue. Q2 fiscal 2026 net sales reached $12.7 billion, up from $5.7 billion in Q2 2025 and $5.0 billion in Q1 2026, reflecting a 123% year-over-year increase and a substantial sequential uptick. Management attributes this growth to the widespread adoption of its AI servers and storage systems by hyperscale and enterprise data centers, particularly those deploying GPU-intensive AI clusters. Design wins that were deferred from Q1 have now materialized, validating that the demand is genuine and not subject to cancellations. The scale of growth on a multi-billion-dollar revenue base indicates that Supermicro is effectively capturing the ongoing build-out of AI infrastructure. As AI model sizes and deployment footprints continue to expand, the installed base of Supermicro systems positions the company for follow-on hardware refreshes and complementary solution sales over the next several years. Second, the company maintains a dominant position among hyperscale and OEM data center customers. Q2 results show that OEM appliances and large data center clients contributed approximately $10.7 billion, or 84% of total revenue, representing 151% year-over-year growth and more than a threefold sequential increase. Meanwhile, the enterprise and channel segment, accounting for 16% of sales, grew roughly 42% year-over-year to $2 billion. This combination of large hyperscale orders and a broad enterprise customer base provides both scale and diversification. Hyperscalers generate very large repeat cluster orders, while enterprise and channel clients ensure revenue exposure across industries and geographies. As long as spending on cloud and AI infrastructure remains elevated, this dual-engine demand model provides a stable foundation for sustained growth. Third, upgraded guidance and strong forward revenue visibility further reinforce the growth narrative. Post-Q2, management expects approximately $12.3 billion in revenue and $0.60 in non-GAAP EPS for Q3 fiscal 2026, sustaining the elevated levels observed in Q2. Full-year revenue guidance for 2026 has been increased to at least $40 billion, up from prior targets around $36 billion and significantly higher than the low $20 billion level achieved in the previous fiscal year. This guidance reflects more than $12 billion in booked design wins for Q2 delivery and continued confidence in ongoing AI infrastructure investments. The clarity provided by multi-quarter visibility reduces near-term forecast risk, indicating that the recent revenue surge is part of a broader expansion phase rather than a one-time spike. Despite a compelling growth profile, several risks must be acknowledged. First, margin compression remains a concern. Gross margins have declined from mid-teens to high single digits, 9–12%, due to competitive pricing pressures in AI server deals and rising costs for liquid cooling and components. With competition from Dell, HPE, and others, average selling prices may remain under pressure, prolonging near-term profitability challenges. Second, customer concentration and reliance on NVIDIA introduce significant risk. SMCI's business is closely linked to NVIDIA's GPU roadmap, and any delays, allocation changes, or strategic shifts by NVIDIA could materially impact growth and competitiveness. Approximately 60% of revenue derives from top customers, creating potential vulnerability if any major client changes supplier relationships or internalizes design capabilities. Third, execution, scale, and governance risks are notable. SMCI is expanding manufacturing capacity rapidly, with new facilities in Malaysia and Taiwan targeting thousands of racks per month. This scale-up introduces execution risks and high fixed costs if demand underperforms. Compared to larger competitors such as Dell and HPE, SMCI has limited bargaining power with suppliers, constraining its ability to maintain discounts without further margin erosion. Additionally, prior SEC-related issues and delayed financial disclosures have raised governance concerns, potentially affecting market confidence and valuation multiples. Supermicro Computer is a significant player in the AI infrastructure market, combining substantial revenue growth, improving free cash flow, and a scalable business model. While near-term margin pressures, customer concentration, and execution risks remain, the company's long-term fundamentals are robust, driven by strong demand for AI servers and enterprise storage solutions. With reasonable valuation levels, a solid balance sheet, and upside potential implied by analyst forecasts, SMCI presents an attractive opportunity for long-term investors seeking exposure to the expanding AI ecosystem.